Vanguard may be the king of index funds, but they also know a thing or two about actively managed funds, especially how to choose the best ones. Joining me to share some of that knowledge is Daniel Wallick from Vanguard's Investment Strategy Group. Welcome, Daniel, and please tell me, index funds or actively managed funds, which are better, or is it a personal choice?
Really, it's a personal choice. We would say the critical decision is cost, that you want to acquire either one at a reasonable cost.
Well, Vanguard is the king of index funds, powerhouse in the industry, but you also offer actively managed funds. How do you choose the managers?
Managers are really two criteria. There's qualitative criteria of do they have talent, and then there's also can we acquire it at a reasonable price.
And how do you get those top managers for cheap?
Right. There are really three key ways that we do that. One is that we can provide a large scale, so the fee can be reasonable. Second is we tend to hold managers for a very long time, on average about 13 years. So the NPV calculation of a modest fee over a long period of time ends up being very reasonable.
So can you give me an example, some of the construction of your actively managed funds?
The construction?
Yeah, so you outsource to a particular manager or set of managers?
Sure. So what we typically do with our active funds, we have about 30 different sub-advisors all over the globe, and we give them different mandates for different size or style funds.
And you make sure there's no overlap, and you make sure that all the different managers work together in that particular fund?
Yes, so some of them have multiple managers in one fund, and some of them have a single manager in the fund.
And for individual investors out there, how should they put together a portfolio mixing index funds and actively managed funds?
We would say you really want to start with a total index base and then move off of that to the extent that you're comfortable with two key criteria. And that criteria is one, the variability of active funds, because they're going to act very differently than an index, so you have to be comfortable with that. And two is that you have to be able to hold those active funds for a long period of time, because again, the return for any alpha of a fund is not going to be every day, every week, every month. It's really going to be variable over time. So if you can live with those two criteria and you can acquire an active fund at a reasonable price, then it's a possibility.
All right. Thanks a lot, Daniel.
My pleasure.
And thank you for watching The Street.